Hello, everyone. Good afternoon and good morning. This is George Constantine, co-chair of Venable's Nonprofit Organizations Practice Group. Wanted to welcome you all to today's session on the unrelated business income tax and the revenue-generating activities that a nonprofit may engage in that might give risk of incurring that tax. It was actually a program we had scheduled for March, and in light of sort of rapid developments on the COVID-19 front, we postponed it and did a session on those coronavirus-related issues. So we're happy to be able to get back into this topic. The process here is my colleague and I, Ann Gerson, will sort of go back and forth on some of these slides. And if you're familiar with the program, there's an ability to ask questions through the chat function. I have to say, can't promise we'll get to all the questions, but we will flow them through and have them for review afterwards. If we haven't touched on them during the call, we'll have an opportunity to look at them and hopefully be able to respond after our session. So today, I'm pleased to be joined with my colleague and friend Ann Gerson, who is a counsel in our Nonprofit Organizations Practice Group, has been with Venable for a couple of years now, but has a tremendous background and career in representing nonprofit organizations, and particularly on the tax exemption tax front. And Ann's integral part of our group and does a lot of counseling on issues like the ones we're going to talk about. And notably, she has a LLM in tax from the NY University, School of Law. So happy to have a great expert on that front. And today, what we want to do is talk about go over some of the basics, make sure we cover the basic points of the unrelated business income tax, talk a little bit about exceptions to that, and Ann will go over the agenda more fully in a few minutes. And then hit some newer topics. But it has been a while since we've covered this in depth as part of our regular program. So I want to take advantage of this opportunity to not blow past some of the basics, but rather cover some of those before we hit some of the more unique and special issues. So our just a very big picture framing exercise. Just wanted to go over how revenue generated by a nonprofit gets treated by the IRS. Generally, the notion is if we're a tax-exempt organization, we're a 501c3, C4, 5, or 6, or whatever it might be, the presumption is the income that we receive is going to be exempt from federal income tax. However, there can be a taxation on income that's viewed as unrelated. And we'll go over what the potential elements of this are, but the general notion is, hey, if you're out there engaging in activities that aren't consistent with your tax-exempt purpose, the money you make from that should be subject to income tax, just like any other tax-paying entity would. However, there's sort of a third step. Even though you may have the development of revenue that might not be generated through the conduct of related activities, but rather may have been generated through the conduct of unrelated activities, you still have the option of perhaps falling under an exclusion or an exception to the unrelated business income tax. And that's what we're going to go through and walk through today is first, what sort of the general rules are for UBIT, and then the exceptions and other approaches that you can consider taking to lessen your exposure on that front. One thing that's notable is we've worked on this for a few organizations recently. There are some unique types of organizations that under Section 501c1 and Section 115 that generally don't have to worry about UBIT at all. Just by virtue of them engaging in the activity that may generate revenue, they wouldn't be subject to tax. But that's a small, very small subset, and not one that we're going to go into any detail today. So I'll advance to the next slide and turn it over to Ann on this one.
Thanks, George, and hi, everyone. I'm glad to be speaking with you today. And so here's just an agenda for what we're going to cover. We're going to start with an explanation of the origins of the unrelated business income tax regime, because that kind of can provide us a framework and a grounding for how we apply the rules in the tax code and to kind of understand where they're coming from. So we'll go over the UBIT test, which is a three-prong test, and we'll examine each of those prongs, and then talk about the modifications and exceptions, and because it's the tax code, the exceptions to the exceptions, which are pretty meaty and is where a lot of the work and questions arise in this area. And there's three types of special treatment that we want to focus on. And so we're going to do a little bit more in-depth analysis of the way royalties are treated under UBIT, also advertising and corporate sponsorships, and then conventions and trade show income. And there have been some recent developments in the UBIT area, so we also want to talk about the recently published silo guidance and the NOL, the net operating loss treatment under the silo guidance has been further complicated by some provisions of the CARES Act, so we're going to cover that briefly as well. And then close out with a little bit of information on the Form 990T, which is how organizations submit their unrelated business income tax to the IRS. And so with that, we're going to go straight into the history of UBIT. Because one of the questions that come up for people, and it's a really natural kind of plain English way to think about it, is as long as the profits from my revenue generating activity are supporting my nonprofit, why isn't that revenue tax exempt? It's all going for this purpose. And it's a great question, and it's kind of the intuitive way that people approach this. So the history can explain it for us. And it helps us understand how to apply things in practice. So we're going to go deep, and I apologize for sending us back to 1913. But that's when the 16th Amendment was passed, which made the income tax a permanent fixture in the U.S. tax system. Don't worry, I won't spend too much time in the past teens.
No, go, please, go ahead.
It gave Congress the legal authority to tax income, and it taxed both individuals and corporations. And there were exempt corporations even in that first law. Organizations that were formed for charitable, religious, or educational purposes were exempt from tax. And so shortly afterwards, there was a 1924 case that made it all the way to the U.S. Supreme Court. And the case was called Trinidad versus Sagrada Orden. And please forgive my pronunciation of that. So it was a religious order that was operated for religious purposes. It was in the Philippines and had missions in China and Japan. And this religious order earned a portion of its income from the resale of wine and chocolate that were used in churches and schools. And when this case came up as to whether it was taxable, the Supreme Court said that as long as the nonprofit spends all of its money doing charitable things, it didn't matter how it raised the money. So it essentially created a destination of income test. As long as the money went to support a nonprofit, it didn't matter how it was raised. But that caused a lot of problems as time went on. And so following this decision, there's a lot of examples of exempt organizations that ran really significant businesses tax exempt. And as George mentioned, I'm an alumnus of NYU, and so I always feel quite protective and amused by this example, which was in 1947. There were alumni of NYU who donated the Mueller's Macaroni Company to the university. And NYU successfully got court approval for the profits from Mueller's Macaroni Company to be tax exempt because NYU was itself a tax exempt educational entity. And this was under the destination of income tax test. And NYU was prolific. They also owned a leather company, a piston ring factory, and a Chinaware manufacturing operation. And other colleges and universities were doing the same. Some manufactured automobile parts, others cotton gins, food products. One operated an airport, and I could go on. And so this was becoming a real industry for nonprofits to create a lot of money. And 2 years later, Congress invalidated the destination of income test, and they passed the Revenue Act of 1950, which introduced the unrelated business income tax as we know it. And that really set up a related test for business ventures by nonprofits as being required for being tax exempt. And so this really developed in response to what felt like abuses of tax exempt status. And Congress was really concerned about unfair competition between charities and small businesses, because of course Mueller's macaroni, when it was owned by NYU, was tax-free, but competing with other pasta companies that had to pay tax. And so Congress's attempt was to separate the revenue-generating activities that were related to the organization's exempt purpose from their unrelated business activities, because that's where the competition was arising. And so UBIT is really all about how income is generated and not what it's used for. And keep that in mind as we go through the regime, the statutory regime of UBIT. And so it's in really four main sections. There's section 511, which imposes the tax. And I'll note here that if you have unrelated business taxable income, it's taxed at the standard corporate rates, whatever those are at the time. And then section 512 and 513 set up both the test for when things are UBIT and some exceptions and modifications to those rules. And as I mentioned before, there's also exceptions to the exceptions. And then there's also section 514, which focuses on the particular treatment of debt-financed income. And we're not really going to focus on that today, but wanted to flag it for you. And then in addition to the statutory regime, unrelated business income tax questions have been ruled on frequently by the courts and by the IRS. And so there is an overlay of court interpretations of the code and the regulations that can also provide a really critical understanding of how they should be applied. And then one final thing before we jump into the UBIT test itself, which is we're going to be talking about the federal tax issues and rules, but many states, in fact, most states, follow the federal rules to at least some degree. So whenever you have unrelated business income tax that's taxable at the federal level, you may very well have state corporate tax liabilities as well.
And just quick note, I mean, because UBIT's taxed at the highest corporate rate, the good news with the enactment of the Tax Cuts and Jobs Act in 2017 was to bring that rate down from 35% to 21%. So while we're talking about the exposure to the organization, due to that decrease, the UBIT exposure goes down as well.
Thanks, George. That's helpful to explain, and some good news when we're talking about tax. So let me get us into what is unrelated business income tax. And just in case anyone's coming to this relatively fresh, we're usually not going to say unrelated business income tax. We're going to shorten it to the acronym of UBIT, just because it's hard to say. And so if you hear us say UBIT, that's what we mean. And similarly, unrelated business taxable income, I may shorten to say UBTI for the same reason. It's just a tongue twister, and we only have an hour to get through this. So you determine whether or not you have UBTI with a three-prong test. Revenue generated by an exempt organization derived from a trade or business, regularly carried on, and not substantially related to the organization's exempt purpose. And you have to have all three of these in order for there to be UBIT. And then after we go through the test, one thing that your UBIT analysis should also include, which isn't specific but is implied, is whether the core activity of the nonprofit is still exempt in nature. Because there's no bright line rule for how much income or expense that's spent on unrelated revenue generation is too much. But there's a fair amount of IRS guidance in the area of revenue rulings, private letter rulings. And they suggest you look at the full scope of a charity's operations. And one of the tests that the IRS has applied is whether the charitable programs are commensurate in scope with the financial resources of the organization. But the IRS also looks to the primary purpose of the organization and the total facts and circumstances. So even though the test is relatively specific, you never want to just focus in on it. You've got to keep your eye on the big picture to make sure that the overall activities are still appropriate for an exempt organization. And one thing I just want to point out while we wait for the slide to load, for the application of this test is that the regulations enshrine this focus on eliminating unfair competition. And so that's really, even if it's not explicit in the statute, it is explicit in the regulations, which are really helpful guidance in this area.
Yeah, and I'll just chime in. I mean, we've done a lot of work over the years with organizations that are being audited by the IRS, and oftentimes analysis of an activity from the eyes of the examiner, from the IRS's perspective, is almost not exclusively, but very much focused on this unfair competition aspect, and the looking to what sort of other sort of tax-paying entities are doing out there. So probably less from a legal perspective and more from just sort of a practical perspective, that aspect of the review of activities as to whether they or generate unrelated business income, that unfair competition, that factor is something that gets probably weighed most heavily from the IRS's perspective.
Thanks, George. That's really helpful. So now I'm going to take us through the 3 prongs of the test. And the first prong is trade or business. And this is about as broad as it could be. It's any activity carried on for the production of income from the sale of goods or performance of services. And the code references section 162, which is early on in the Internal Revenue Code and kind of governs for-profit businesses as well. And there's a ton of guidance under 162, which essentially means any activity carried on for the production of income from the sale of goods or performance of services is considered a trade or business. It's about as broad as it could be. And there's a couple ways to look at analyzing this. It's not just the unfair competition, but there's also profit motive, which can be one way to try to determine whether something is a trade or business, if it's operated in a commercial manner. And it doesn't matter if you don't make a profit, it's the manner that you try to do it. And if you don't make a profit and you have a business that is a trade or business almost exclusively to generate losses, those could be disallowed if you're trying to use it in a UBIT way. And so the trade or business inquiry is not usually where organizations have a lot of trouble. Generally, everything is captured, and the IRS will use different ways to prove that something's a trade or business based upon the activity. And then the second prong is regularly carried on. And this is a facts and circumstances analysis that really goes to the frequency and the continuity of the activity. And this one is trickier than trade or business. There's a bit of nuance here. And the IRS looks to the manner in which activities are pursued with a baseline of a comparison to similar activities that would be carried on by a for-profit business. And so, for example, you look defining what the comparable for-profit business is can really help focus the inquiry. So, for example, if you have a nonprofit that runs an ice skating rink, the comparable for-profit business is also running an ice skating rink. It's not an organization running a year-round casino, because even though they're both entertainment venues, they have a very different window of use. One thing to note is that fundraising events are excluded when you're looking at the frequency and continuity. They're considered occasional and sporadic, even if they're annual. They're simply just not treated as regularly carried on. And another example that helps us understand the seasonal comparison, there is a case, Veterans of Foreign Wars of Michigan versus IRS, and the Veterans of Foreign Wars tax-exempt organization was selling Christmas cards. And that was found to be unrelated because even though it was intermittent and seasonal, the seasonal participation was regularly carried on, and the comparison was to other for-profit businesses that sell Christmas cards. But it gets very specific. There's also a case about the programs that were sold at NCAA tournaments, and this made it to the 10th Circuit, who decided that revenue from the tournament yearbook, ads that were in the tournament yearbook, wasn't subject to UBIT because the comparable for-profit entity was a sports magazine that was published year-round. And by that comparison, the tournament program was not regularly carried on because it was a short, presumably March, window of time. So regularly carried on, important to remember, is you compare to a comparable for-profit business, and it might be seasonal. And then the third prong is whether or not it's substantially related to the organization's exempt purpose. And this is usually the most critical and most important and the most complicated to analyze. Because in order to escape UBIT, there has to be a substantial relationship between the business activities that are being carried on to generate the revenue and the fulfillment of the organization's exempt purposes. And technically, the regs look to the organization's particular purposes, but in practice, we've found that the IRS really takes a slightly broader lens and looks at 501c3 purposes generally. But it's a subjective analysis. It's based on really particular activities. And one thing that's important to think about in terms of application of this is it can be different for a 501c3, a 501c4, or a 501c6 based upon the exempt purpose. In the association context, an exempt purpose is really directed toward the improvement of the members' business conditions. And so activities to benefit members as a whole instead of individual businesses would presumably be related. But it may not be so if it's an activity that benefits individual members. And then another thing that's interesting about the way the IRS has applied this requirement is they may fragment income into related and unrelated. There's a series of rulings that the IRS made regarding the treatment of income from museum gift shops. And so it's one activity, but the IRS will divide the activity into its related and unrelated parts. So for example, in Washington, D.C., if you have an art museum that is selling posters and scarves with art in the museum printed on them, that would be considered a related activity and not subject to UBIT. But if they're also selling maps of DC and of the greater metro area, those would not be related to the organization's activity as an art museum, and so would likely be taxable. And so the IRS review and analysis can get that granular and really go item by item. And sorry, I'm having a delay on the slides, but I think now I'm going to turn it over to George to go into how advertising income is treated.
Great. Thanks very much, Anne, and that's good to have this sort of grounding in the concepts here. We thought we'd start on the types of unrelated business income or activities that really generate unrelated business income before we get into some of the sort of exceptions to the rule and things like sponsorship and royalty and all these sort of ways that an organization can manage its exposure to unrelated business income. And we'll start with what I think is kind of the quintessential type of activity that most organizations that generate unrelated business income for most organizations, and that's sort of the sale of advertising. And it could be in the form of ad space in a periodical or advertising on a website. That type of activity, is almost always, if regularly carried on and meeting the other sort of elements of unrelated business income tax, are almost always going to be viewed as taxable. It is almost always a losing argument to say, hey, this is actually related to our exempt purpose because the advertising that we're selling in our magazine or on our website is helpful to, for example, our members. Or there was a Supreme Court decision on this in the 1970s involving I think it was American College of Physicians, where that was sort of the argument, was like, look, these are physicians. They are the advertisements actually help them understand better sort of the products and services in their field, which would therefore help make them better doctors. The Supreme Court was not having that argument on the relatedness side. But I'm jumping ahead. On the regularly carried on side, we did talk about and talked about the notion of an annual activity, like an annual yearbook, where advertising is sold in the annual yearbook. Is that in that situation regularly carried on and therefore going to generate UBIT from the advertising income? And we do have a good case from the taxpayer's point of view in the NCAA case that Ann referred to, where the court said that no, that annual yearbook should not be viewed as being regularly carried on. I would say that most of us are on the call are probably more thinking of advertising in a more regular periodical type publication or on a website. So when it comes to the substantially related aspect of the test, very often, if not always, you're going to find that sort of activity is not going to be viewed by the IRS as related. It's interesting. There's no definition in the code, the tax code, or the regulations with any specificity as to what is advertising. I think as we talk a little bit later about the sponsorship exception to advertising, we'll see sort of, in a way, the way the IRS or Congress may view what advertising is by how it defines what it is not. And we'll talk about that when we hit that point. But one point about advertising that's important is there are very unique rules for calculating how you determine what the net income is and what is therefore subject to tax. Obviously, as we're talking about the unrelated business income tax, it doesn't apply just on general revenue or total revenue. We're able to deduct our costs against it. In the case of associations in particular, the calculation of those direct advertising costs and other costs that can be applicable against the revenue are very sort of much prescribed by regulation, also taking into account an allocation of income that is presumed to come to the organization through membership dues as well as the advertising income. And then there's a sort of a formula that's in place for doing that. So that's it. I think on advertising, I'll not spend a lot of time so we can get to some of these other points, other than to say this is an area that we've sort of over the years identified as one that has very few exceptions to the rule, and it's very difficult to get out of taxable treatment for advertising activities. There are a lot of other types of activities, and recent IRS enforcement has identified different areas of concern. And I've noticed that while Ann was talking, I paid some attention to some of the emails or texts coming through with questions about types of activities. And, the top of the list here, one of the questions that came up is, what about consulting services? So say we are let's give one example. We're a 501c6 association. Our members are companies. We, as an association, have developed unique expertise in advising companies on how to operate efficiently and effectively. How about we start offering a service that's effectively a consulting service that we'll offer to our members? We'll come in, view their activities, and advise them as to how they can be more effective and sort of better widget manufacturers or whatever it is that the association focuses on. Sounds like it could be related, right? I mean, a tax-exempt 501c6 organization has sort of as a mission, the advancement of a line of business, a profession, an industry. And by helping each individual company do better, aren't we effectively helping the industry? But the IRS generally says no, that consulting and management services arrangements where the organization is providing some level of tailored or focused advice, particular to the member, particular to the recipient. The IRS has said that that's a activity that's not consistent with 501c6 tax-exempt purposes, and therefore income from that, net income from that would be subject to tax. And that also comes in, I say management services, I kind of lump that in with consulting. Oftentimes we have worked with organizations that have families of organizations for whom there's a management fee paid up to the related organization. Sometimes there's a way to treat that fee as not subject to UBIT if you're closely aligned to two organizations. But if you have unrelated organizations and you're receiving a management fee for providing services for that organization, almost always the IRS is going to view those management services as not as subject to UBIT because not related to exempt purposes, even if the organization or company that's being managed is also exempt under the same section of the code. So that's a trap to be wary of. And oftentimes in the 501c3 context, you'll see, with the published IRS denial letters for organizations that applied for exempt status recognition, where very often people come in with the misconception that, well, providing this consulting or this management services to other C3s, we're benefiting the public, which is a C3 requirement. We're benefiting the public by benefiting these C3s. And generally, no, those types of activities are viewed as unrelated in the eyes of the IRS. Other activities that we've seen recently with IRS rulings come up as not related to exempt purposes. Job listing services, this is not so new anymore, but the online service where a job seeker can come in, type some search terms, and generate a bunch of results of job opportunities in an industry. This is, again, mostly in the 501c6, but also in the C3 world. The income from the sale of the listing of those job listings is generally viewed as taxable, as unrelated to exempt purposes. And then in the C3 context, and I saw some questions scroll through on this already for today. There have been a number of letters from the IRS recently addressing the activity where a 501c3 may engage in some sort of retail or food service or other types of business activities with the underlying purpose being job training or perhaps improving a blighted community or something like that. The IRS takes the view, we'll look to sort of the substantiality of the activity, the substantiality of the benefit to the public, in this instance, training for people who may need it or improving a blighted community, and weigh that against the substantiality of the other benefit, the benefit to the sale of retail products, to the sale to the operation of a restaurant. And it's a weighing, sort of very subjective test that the IRS will take when they view this. But more and more, the IRS seems to be taking a narrow view, and it's looking for a lot of evidence of that public benefit to outweigh the sort of more private benefit to the business or to the activity. So it's even those with sort of the best of intent on these types of programs have to be very mindful when setting up a program like this to really establish the underlying purpose, the publicly beneficial purpose. And if it is job training, for instance, if it is improvement of a blighted community, really document that and make sure that the entirety of the program is structured in a way to maximize that benefit and to sort of minimize some of the unfair competition and other aspects that we talked about earlier. And there are some kind of roadmaps in place that the IRS has approved, either through private letter rulings or revenue rulings or other proclamations. So this is not sort of entirely new ground, and there are ways to do this in a way that would minimize UBIT risk. It was interesting. There was a case recently involving a Panera Bread Company related foundation, the Panera Foundation, that had operated certain retail outlets called Panera Cares, where customers were not required to pay for their meals. There were suggested donation levels placed on the menus, but the notion was that it was a way to a way to sort of benefit the public through allowing lower income people to have free or reduced cost meals, free or reduced cost food. And also an aspect of the structure of the Panera Cares outlets was that there was a job training aspect to it too. The IRS refused to or sought to revoke their exempt status. The Panera Foundation took the case to the tax court, but very recently submitted a filing to withdraw their appeal. And I understand through press reports that all of the Panera Cares outlets are now closed. So it's an indication of sort of the IRS's view on that. Now, obviously, there's some issues the IRS raised in its revocation letter there about the close connection with a for-profit company and those things, which we won't go into today. But again, another sort of view into where the IRS stands on some of those types of activities and where the risks can be. Other types of activities that generally are going to give rise to concern on the UBIT front include, just over the course of IRS enforcement of the years, what we've seen, again, from the C6 perspective, sometimes there are associate member categories that may be formed in a way that the benefits are so obviously sort of unrelated to the C6's purposes. And I'm thinking of, hey, join as an associate member and you get free advertising in our magazine, or join as an associate member and you get, this was a C5 a while ago, the Postmasters, you get access to our unrelated insurance program. Just because you're calling it dues doesn't necessarily mean it's per se exempt from or free from unrelated business income tax. There have been extreme situations where associate member dues have been viewed by the IRS as generating taxable income. And other sorts of activities that sort of, I would say, straddle the line on unrelated activities include sale of clothing, merchandise, and other logo materials for a 501c3, for example. What the IRS has said is, if you can make a tie with your exempt purposes through that sale. I mean, there's an example IRS has approved in a private letter ruling involving a sale of logo material, where the logo itself was so sort of intertwined with the message of the 501c3. It was a private letter ruling, so it was anonymous, but I think it was a cancer-based charity, that the awareness generated through the wearing of that apparel was enough for the IRS to say that the net sales from those products did not generate unrelated business income. But again, that's an area that's definitely straddling the line, and there may be situations where organizations are involved in those sorts of sales that could very well generate unrelated business income tax. I think with that, click to advance, and I think it goes back to Anne. Oh, before I do, one thing I wanted to say about, and we'll talk a little bit about this, but if you have revenue paid up from a controlled for-profit subsidiary in the form of some of these exceptions that Anne's going to talk about now, including royalty, even though there may be an exception in place, you still may be obligated to pay UBIT because of the controlled nature of the relationship, and that's written in the tax code. I wanted to make sure I hit that. Back to you, Anne.
Thanks, George. I appreciate it. So I'm going to talk now about the tax code's exceptions to UBIT, which are basically two different categories of income that pass the UBIT test. They have all three criteria, but Congress has determined that they should not be taxable to exempt organizations. And so the first lump of these types of income is in Section 512B of the code. And these are types of income that just are not taxable by virtue of the quality of what they are. And so that's investment income, royalties, rent, capital gains, research-generated income, and income from religious services. And as George mentioned, there can be exceptions to these exceptions, depending upon if controlled subsidiaries are involved. There also are other exceptions built into the code for pretty particular circumstances, like if you're earning income from shares in S corporation, for example, that's automatically UBIT. If it's debt finance income, that may be UBIT. There's also particular rules when it's income coming through the exempt organization's participation in a partnership. There you can look through the activities of the partnership. So the most important thing is to know that these categories of income are excluded from UBIT, but that you do have to do the third level of analysis, make sure there's no additional exceptions that would apply to any particular income. And then the other bulk category of, sorry, waiting for the slide to load, of exceptions from income is these are exceptions where Congress has said this activity is not taxable. We're not going to treat this kind of activity as a trade or business. And so I want to go through some of these in detail. And then, as I mentioned when we talked about the agenda, there's a few of both the previous exceptions and the ones here that we want to talk about a little bit in depth. But interesting ones here are the volunteer exception. If you have an incredibly large enterprise, but substantially all the work is carried on by volunteers, that's not considered a trade or business. Things to watch out for here are payments by third parties and if the volunteers are tipped, because those are characteristics that can tip you out of this safe harbor category. There's similarly an exception for donated merchandise, which allows you to have a thrift shop that doesn't generate unrelated trade or business. Another important exception is the exception for income from the rental of mailing lists. And this is narrow. It only applies if an organization rents its mailing list to another exempt organization. Also exempted as not a trade or business is sending low-cost items along with your fundraising efforts. And so this is essentially the exception for tote bags and personalized mailing labels that you get in the mail. As long as the items are under a certain threshold, it won't be considered a trade or business. And finally, one last one I want to highlight is the non-commercial bingo exception, because there's clearly a very strong bingo lobby when these regulations were being written and put into place. And now we'll turn back to George to go deep on royalties, which is one of the areas of unrelated business income tax exceptions, which we see the most in our practice.
Great, thanks. Yeah. We certainly see this a lot, and I'll go into some detail on the royalty front. I did notice a couple of questions flowing through just to make sure we hit the big ones. I should sort of distinguish the notion of sort of general education and providing sort of publicly beneficial educational activities, be it some sort of broad training, those sorts of things can be distinguished from sort of the consulting services I said, and the provision of education is generally considered a related activity. So sort of flow back to what I was talking about with some of those unrelated categories, and then also some questions about the payment of management services among related exempt organizations or within a close family of organizations, and does that generate UBIT? We've looked into that, and the IRS doesn't have a sort of a clear path. There is, at least in one private letter ruling, a an allowance for the fact that, a shared services arrangement among a family of entities is, unlikely to be viewed as unrelated and therefore unlikely to generate UBIT. In our experience, it seldom comes up as a real issue because at the end of the day, most of these arrangements have very little, if any, profit at the end of the day. So the net exposure is zero, whether it's treated as subject to UBIT or not. So yeah, just to answer those two questions that came through, sorry to go back a little bit there, but royalties. So there's an exception, as Ann just pointed out, written into the tax code for royalties. No great definition in the statute or the regs as to what a royalty is. It's really developed over the course of many, many court decisions, and largely what we come down to is sort of the second and third bullet points here. Payments for the use of valuable intangible property rights, or in the DAV case, and then in the Sierra Club decision from 1996, made to the owner of property for permitting another to use the property where the property is either an intangible property right, so there's that term again, or right relating to the development of natural resources. We'll not go into mineral royalties here, but the big exception that came out of Sierra Club and other cases is it cannot be construed as a payment for services. So where the rubber meets the road with royalties from a very practical level for so many of you on the call is we let someone use our name and logo. So there's a trademark license there. Maybe it's a company with interests in our field or wants to market itself with a connection to the exempt organization. That mere license and sort of allowing that company to have an intangible property right, generally consistent with what we're seeing the courts are saying a royalty is. However, if we couple that arrangement with some level of services, such as will help the company market its services, say for a membership organization to our members, we then risk the ability to treat that income as subject to the royalty treatment. So we'll go over some of the sort of strategies in place that you can take to perhaps engage in some of those services and not jeopardize the full amount of your payment and be able to have a limited UBIT exposure. So I'm going on to the next slide. So here's a typical royalty arrangement we'll see. There'll be a license of either your name, a trademark, or maybe it's the membership mailing list or some other mailing list, a donor mailing list. And for purposes of this example, say it's to a for-profit. And usually in the case law, I mean, the best example, because we've seen it over and over again involving Sierra Club and then some university alumni associations, including Oregon State, had an important case on this. Usually the case examples, for whatever reason, affinity credit cards were really big there. And what are those? Those are those credit cards that your alumni association may have the logo, the name, a colorful photo of the mascot of the alma mater on the card. It's an arrangement with a MasterCard or a Visa, whereby the alumni association, a tax-exempt organization, gets paid a very small percentage of transactions using that credit card. And usually that arrangement, if you want to have a sort of clear and safe path to royalty income with no UBIT, there'll be no active promotion by the nonprofit. What has been allowed in the case law, and we'll get to the more sort of detailed or specific situations where there is promotion in the next slide, but what has been allowed on sort of from the IRS's perspective and from the courts, the types of activities that an organization can engage in and not jeopardize royalty treatment may include some quality control measures, such as we want to make sure that when you use our name and our logo, be it in advertising or other aspects, that you're not doing it in a way that would besmirch our reputation. And oftentimes too, it's as simple as we want to make sure you use the right font, we want to make sure you use the right color, and those sorts of things. But also, we don't want you to use our name and logo in connection with something that we don't want to be connected with. So we do get that sort of authority to review those activities, and that's not viewed as a service that would jeopardize royalty treatment. The types of services that would be viewed as jeopardizing royalty treatment include the promotional side, if we're helping market it, or helping to sort of, and somehow endorsing the program or service, and other types of activities like helping the organization in dealing with customers and those sorts of things. Look, what normally happens, particularly within the association context, is you have a company that's interested in using your name and logo and marketing to your members. And so you license them your name and logo. You may license them your membership mailing list. But they want more than that. They don't want to just stop there and listen to us say, well, actually, from a tax perspective, we have an interest in keeping this passive. We don't want to be active in promoting you. The companies want more. So oftentimes what we'll suggest, I'll move on to the next slide here, is that if you have to do it this way, let's at least do it in a way that manages our it just loaded. Okay, that respects the separateness of the two transactions. Because really, what we have here is a license of our name and logo, which is something intrinsically of value that someone should be willing and is willing to pay for. And then, secondly, a second aspect to what we do is the marketing, promotion, and services. It's really two different streams of revenue that are coming in. And in fact, in the Oregon State University alumni case, when the IRS was trying to say, hey, this alumni association is promoting this credit card, so it's not just getting a passive royalty, it's actually actively promoting, and therefore it's in the business of selling a credit card. And really, the services they're providing is, someone is helping, handle customer service calls for that sort of thing. And the court said, look, basically, given the small level of services that were actually provided here and the small level of benefits, there wasn't a lot of promotion either. You would be asking us to assume that this full multi-million-dollar payment that was received over many years was sort of all in exchange for those promotional and services provisions and nothing attributable to the license of the logo. So the court in that situation sort of beat us all off as practitioners to say, okay, well, what we could do then is maybe separate it out and avoid the risk of more than a small amount of services or more than a small amount of promotion actually tainting the whole transaction and having the IRS say it's all taxable. Let's have a dual bifurcated approach where we might have two agreements. One, the license for the logo and the name and the mailing list, which gives you the benefits of royalty treatment. You're not subject to UBIT on that, and the other for services. So that's an approach that can work. Now, obviously, it's great to have those contracts in place and have good documentation of that, but you have to sort of respect that too. The division between the services and the royalty revenue has to be fair. It's a difficult one to come at, but essentially the services revenue should not be a loser every year in terms of net income. If that is, then it would tip the IRS off to say, well, you've sort of created a form over substance transaction where you're really avoiding your unrelated business income tax by underpricing your marketing services and overpricing the license. So to the extent that we need to be active, to the extent that we want to have or are willing to have a role in a royalty relationship, the way to manage risks on that front is to look to ways to separate payments and bifurcate. And I'm moving a little faster now because we're running short here, so I'm switching to the next slide and back to Anne. Who may be on mute.
Thanks, I was on mute. But I will take us quickly through commercial co-ventures and corporate sponsorship. And I've seen a number of questions come in on these kinds of issues, so hopefully we'll cover and address some of those in the slides. And commercial co-ventures are charitable sales promotions. Sometimes they're called cause-related marketing, and they're heavily regulated under state laws, but they also may have UBIT implications. And they kind of straddle the line between royalty and advertising. And you look to the same test that you would look to in the royalty context. If the charity's role is passive, then you can probably treat the income as related, as exempt through royalty and would be public support income. But if the charity has an active role as promoting the purchase of the items that are subject to the CCV or providing services to the for-profit company, then you may be in a taxable situation and you want to bifurcate the payments as in a royalty arrangement, or you may want to take advantage of the corporate sponsorship exception. And the corporate sponsorship exception is baked into the code. It's relatively new. It was added in 1997, and it came up because people wanted to sponsor bowl games. In particular, the IRS was trying to tax sponsorship income received by the Cotton Bowl, and there was a public outcry. And although it has applicability to almost all organizations, it has become a major feature of the bowl games, and they now are branded, including in 2020, there was a Tax Slayer Gator Bowl, which is ironic on a couple levels. And corporate sponsorships exclude what's called a qualified sponsorship payment from taxable income. And there's really specific requirements in order to qualify as a qualified sponsorship payment. And importantly, a corporate sponsorship has to be written in an agreement before the sponsorship event occurs. And here the key is that no substantial return benefits are allowed to the sponsor. The only two things that are allowed are use or acknowledgement of the sponsor's name or logo. And as George alluded to earlier, this is where we get into what the IRS thinks is advertising and what it thinks is passive. And then there's also an allowance for a small amount of disregarded benefits, which is essentially under 2% of the value of the sponsorship payment. You're allowed to get advertising back or other kind of direct benefits to the sponsor. And so this slide covers briefly what the IRS thinks is allowed and what it thinks is advertising. And so what it thinks is advertising is qualitative or comparative language. It's really including price information or a statement of value, like this is the cheapest and best quality XYZ you could buy. If the charity gets an endorsement, that's also generally considered to be advertising. Or if they're an exclusive provider of their product at your event, that is considered outside of the realm of a use or acknowledgement. Use or acknowledgements are essentially passive. They're logos and slogans. They are contact information. They're displays. And in a true complicating factor, you can be an exclusive sponsor and still be in the use or acknowledgement category. You just can't be the exclusive provider. So
right. When they were coming out with these regulations on that, right? When they were coming out with the regulations on that, and the exclusive provider, the benefit obviously is, say you are in the bowl game situation, and only Coke's the only, as part of the sponsorship agreement, they get to be the only seller of their product, of their soda, Pepsi's not allowed, or RC Cola's not allowed. That's where the exclusive provider comes in. But you could say exclusive sponsor, the only person who's going to get all of these benefits is in this particular industry, or in the case of Coke, we're not going to sell a sponsorship to Pepsi if we've sold one to Coke. That's sort of the way to differentiate there.
Thanks, George. Then the disregarded benefit, I alluded to, it's the 2% threshold. And what's important here, and I think has come up in practice for us, is if your sponsor wants more than what would be allowed as a disregarded benefit, you can set your agreement up around that. And George, I think you've had particular experience on this, so if you have any experiences to share, that'd be great.
Yeah, sure. I would say what I wanted to bring up in this situation is if there are benefits that exceed the disregarded level, if there are substantial benefits, it's very important to note that you're only taxed on the value of that substantial return benefit. So unlike the royalty discussion, because I feel like royalty and sponsorship are basically two sides of the same coin. The way to sort of put yourself in a good tax position is to stay passive generally, and not promote the product or service. But on the royalty side, you run the risk of a little bit of promotion or some services actually tainting the whole transaction. The IRS coming back, if you don't have the good bifurcated structure like we talked about, coming back and saying, you're taxing you on the whole thing. The sponsorship rules written into the tax code and also into the regulations is that you're only taxed on the value of that substantial return benefit. So if you get a sponsor that's willing to provide a significant payment, but they're insisting on, in addition to recognition, their name and logo plastered across the stadium or whatever it might be, but not just recognition, they also want advertisement in your publication, for instance, or they want you to otherwise sort of promote them, which would be a substantial return benefit. You value that and you pay tax on that. You don't have to pay tax on the whole sponsorship payment. Now, note that you have to do a good job of documenting what the value of those substantial return benefits are, because you could do battle on that later. But the general concept that you can segment that out is very helpful from a tax perspective. Okay. And we are on borrowed time. I understand that. So convention and trade shows, I can handle this rather quickly. There are a couple of things. Just on the royalty front, I saw a question come through. I didn't say this, but obviously if the company markets the program and pays for the marketing of the program, that's not going to be attributable to the exempt organization. So that wouldn't present a risk. So I wanted to handle that question. Conventions and trade shows. So there's written into the tax code in 513D is a exclusion from unrelated business income tax from revenue received from the conduct of qualified convention and trade show activity. And it generally applies to C3s and C6s. One might think, particularly in the C6 contest, that obviously a convention or trade show is related to our exempt purpose. It promotes the industry and profession. But regardless, there's a written into the tax code exception to the unrelated business income tax. The regs have some definition as to what constitutes a qualified convention and trade show activity. I think it's well past due for some updating. Generally, income generated in the convention and trade show context, sort of one of the key points of this is your exhibit space rental money that you get from exhibitors at your trade show is not going to be taxable due to the convention and trade show exception. One point that I wanted to make sure we did talk about regarding this is more and more there are for-profit companies getting into the business of investing in trade association, professional society, and other types of groups, investing in their trade shows and getting an ownership interest in and creating some sort of joint venture. There's been some favorable rulings from the IRS on those types of transactions, which provide some helpful guidance as to how to structure those types of transactions, where the revenue that continues to flow to the exempt organization after the joint venture is entered into, even though it's a for-profit on the other side, if structured properly, that revenue can still be subject to 513D and therefore not taxable. So, like I said, there's a lot of activity on that front, or so it seems, and there are ways to structure those deals so that the exempt organization, retains the ability to take that 513D treatment for the revenue. Okay, and that was it on convention trade shows. I've advanced to the silo slide for you, Ann.
Thanks, and I will. I'll let everyone know we have a couple slides left, so I think we've gotten the green light to finish off, but we recognize we're going a little over time. So if anyone needs to drop off, I want to share what the CLE code is. The CLE code is UBIT. So if you have to leave, you can at least still get your CLE. And so I'm going to talk very, very briefly about the silo guidance, which was just published. And this is a recent development. The Tax Cuts and Jobs Act of 2017 introduced a couple UBIT-related provisions to the code. One of them has since been repealed. There was a brief period of time where there was taxable income generated from parking and fringe benefits, provided by exempt organizations, but it caused a lot of complications and confusion and was ultimately repealed by Congress. There was also established an excise tax on compensation over $1 million. So that's another area of potential taxable income for exempt organizations. We're not going to go into detail on that, but just wanted to let you know it was there. And then the third UBIT-related provision.
Sorry, to clarify.
Oh, George, please.
On that one, it's on over $1 million in compensation. That's the key. Over $1 million in compensation. I don't know if you said compensation, but go ahead. Sorry.
No, thanks. I might not have. Trying to go too quickly. But so the third piece of UBIT-related law that was enacted by the Tax Cuts and Jobs Act was something that essentially required nonprofits to calculate their income from their various trades or businesses in separate categories. And so that's why people have called it silos. You essentially have to silo the income and deductions from one activity from the income and deductions of a different unrelated business activity and calculate them separately. Before that, organizations with multiple trades or business would aggregate them all, so aggregate all the income and aggregate all the deductions. And that obviously was much more tax beneficial because if you had a fair number of deductions in one business, you could apply those deductions to your a different profitable trade or business income and have overall a lower tax base. And with the silo guidance, organizations now have to group their income and deductions by activity. A notice came out in 2018 right after the Tax Cuts and Jobs Act, which gave some guidance, and it was a little bit more complicated than what was announced recently in the proposed regs for how to calculate what belongs in each silo. And the most important piece of this guidance is that nonprofits can look to the North American Industries Classification System, the NAICS codes, for identifying what trade or business goes in which silo. And in the notice that I mentioned earlier, they looked at 6 codes, which obviously got more and more granular in terms of describing and separating organizations. And the guidance now allows nonprofits to look only at the first 2 digits of their codes, which means that there's 20 possible silos. And so that will hopefully allow some organizations to group activities together in some part, but at least it gives a workable level of clarity. And then there's a couple of kind of really detailed things to know about in the guidance. There's special treatment for investment activities. There's also special rules governing the treatment of debt finance income that would otherwise be investment activity income. And there are certain look-through rules for pass-throughs. And finally, this is interesting, but charitable contribution deductions can also be taken against the total UBIT. So after the silos are aggregated, then you look to apply a charitable contribution deduction. So that's a benefit in kind of looking back to the old rules in a way to allow a general benefit. And as I mentioned when I went over the agenda, one of the elements of the silo rules is the treatment of when net operating losses are available for carry back and carry forward. And I just want to alert you to the fact that there's some overlay with the CARES Act that the regulations explicitly avoided addressing because the CARES Act repealed some of the limitations that the Tax Cuts and Jobs Act put in for NOLs. In particular, before the siloing rules, you could use 100% of your net operating losses in a carry forward way. And 512A6, which was introduced with the silo rule, NOLs are limited. You can only use them up to 80%, and they expire after a certain period of time. And so this is an area where there's not a lot of clear guidance, but if you have this as an accounting issue, you should you should seek counsel and look closely at how to apply them, because there may be some real opportunities for benefit. And with that, I will turn this over to George for our final topic.
Great. So yeah, basically last on our plan discussion is how do we sort of account for and pay our UBIT, and that's the Form 990T. If you have a unrelated business income in excess of $1,000, you have an obligation to pay through the filing of the 990T. And note that if you're a 501c3 organization, that document, just like your regular Form 990, is available for public inspection. The other point, just to sort of close out the discussion of the 990T, the types of issues that could arise that might trigger an audit is if you're, and believe me, this happens more than you would think. The 990 may report that you've received or categorized some of your revenue as subject to UBIT, but there's no 990T filed. That will sort of hit a trigger and could trigger an audit from the IRS. If there is a lot of unrelated business income, and we could get some questions roll through here. What is a lot? Like, what's substantial? The notion here is, hey, if you're a 501c3 organization, for example, and you engage in unrelated activity and you generate unrelated income, or you pay this UBIT, or you just fine. Well, you are up to a point. If there's a substantial amount of non-exempt activity within the organization, you obviously could be at risk of losing your exempt status in total. And no one has sort of the magic percentage number on hand as to what level is too much unrelated business income that you need to think about sort of putting it into a taxable subsidiary. We'll normally say, in the 20% range or around there is when you might want to start thinking, is it 20% of overall income? You might want to start thinking of putting that into a taxable subsidiary. But the rulings on that are very fact specific. But that, obviously having a significant amount of unrelated business income could be concern for your exempt status and the commerciality issue too. So with that, I appreciate you indulging us. This is one of those topics that's very meaty, so we did have to take some of your time at the end here. I did see a lot of questions. One interesting one about what about virtual trade shows and the convention and trade show exception to that. We'll post something on that. That's an interesting question. There is actually guidance from the IRS on virtual trade shows in this day where we're having very few in-person events. So we'll supplement that and all the other questions as well. But I think, am I ending it too soon? Do we have another one or? No, maybe
no,
not.
I think that's it.
Okay. There we go. Good. Well, thanks everyone for your time, and thank you very much. And stay tuned for more invites for more of these webinars in the future.
Thank you all.